Hi, everyone, and good afternoon. I'm Tiffaine Beauperrin, the CEO of FERMA, and I will be hosting today's webinar. After the success of our first session of our webinar series titled AI Unveiled for Risk Managers, today we enter part 2 of our series. And since our first webinar on AI in February, the EU AI Act has been fully adopted. However, the important part comes next, implementation, and how companies are implementing AI into their systems and processes. So that's why today we want to focus on some more of the practical ways AI will have a transformative impact on the field of risk management, which also includes insurance management. And this webinar is therefore aimed at being more practical than the first session. We will then continue to build up the knowledge and expertise in the FERMA network in the third session of our webinar series, which will be on the Thursday, the 13th of June. This one will be more an open Q&A with all our experts who have participated over the two first webinars, and you will be free to ask all the questions that you may have. And when we reach the end of this series, we definitely hope that you'll be better equipped to take on AI and risk management. So for today, in the spirit of fostering collaborative learning and meaningful exchange, we've brought together some really engaging speakers who will all talk about AI. But before I introduce our speakers, I'd like to give you some few housekeeping notes. You probably know them, but it's always good to remind them. There will be a Q&A session toward the end, and we will welcome your questions throughout the webinar via the Q&A function. And also, please give us your feedback at the end of the webinar via the link which will be provided on the screen or using the QR code. But now on to our speakers. Today, I'm delighted to introduce our esteemed panel of experts. Barbara Meyer is risk management expert at SAP. Barbara also was in the first webinar in our series on February. So thank you very, very much, Barbara, for coming back again. So Barbara has a diploma in business informatics, a master's degree in law, and she has over 30 years experience as project leader, expert, and manager in the enterprise software, electronic, manufacturing, and printing industries. Barbara worked for 24 years in the compliance, security, and risk management field, with a special focus on cross-IT and legal topics, artificial intelligence, data privacy, and sovereign cloud risk management. Welcome, Barbara.
Thank you so much.
We have also around the table Marco Lo Giudici. I hope I pronounce well your name. So Marco has a PhD in mathematics. He's the head of emerging risks at Lloyd's with almost 20 years of experience in the insurance and reinsurance sectors. And Marco has contributed to the development of a cyber model when no standard methodology existed. He brought together the world of insurance with the world of cybersecurity and delivered a model fit for purpose, not only to quantify underwriting risk, but also operational risk. And our third speaker is Salman Siddiqui. He's a senior director at Moody's Analytics. He's a specialist in insurance for Europe and Africa with expertise in IFRS 17, ESG underwriting, capital management, financial performance, and financial reporting. And with over 15 years of experience across major industry players, he guides insurers in navigating regulatory and financial complexities. So thank you to our three speakers. Salman will has just joined now. So Salman, thank you for joining. Thank you very much for all of you today, your collective expertise spanning the field of technology, risk management, and entrepreneurship promises to enrich our exploration of AI's profound implication for risk management. But without further ado, I will now give the floor to Barbara, who will tell us about a specific way she is looking at risk related to AI. Please, Barbara, the floor is yours.
Thank you very much. Thanks for having me. Could you please go to the first slide? Thank you so much. To those who already listened last time, there I already said risk management is a joint effort. So it is not solely the risk management department doing it. You have a special risk management. You have AI risk management, plus you have the normal risk management. And overall, you have that AI ethics governance, so policy. I already said to Charles, we should have a dedicated session on policy, but I won't focus today on that one. So let's start in the development department, or where the AI use case come from. So it starts with the ideation phase. Someone has an idea, a new AI use case is created. We are performing this as a self-assessment. So the use case owner, the AI developer, they do together the self-assessment and the risk classification. What I mean by risk classification, I will explain in a second. So any potential high-risk use case, I think, as Tiffen already said, the AI Act is already more or less on, meaning, and as you may remember, HR AI, so high-risk AI use cases are playing a central role there. So we have to identify what is a high-risk use case. And for that, these are going to the AI steering committee. That is a cross-functional board that of executives, and that evaluates the risks and chances of the use cases. And then we have, in the end, the normal risk management. Normal meaning not AI specific, but the general way you have to do your risk management and keep that auditable as well. Could you please click so that we see the next slide? Thank you very much. So as said, what is crucial is that you have the overall framework. That framework is explained within the policy. And you should have an internal committee, the AI Ethics Steering Committee, as well as an external committee, the AI Ethics Advisory Panel. So as said, any high-risk cases are additionally assessed by the AI Ethics Steering Committee, because it's also a matter of business case. In case you have a high risk, there must be an explicit yes by business, because of course you will have higher risks and higher costs of compliance, and it must be worth it. That's the reason why a business got to look at it guided by the legal expert, whether it be DPP, so data privacy experts, or just regulatory office. And of course, also the external guidance. So the external experts have to have influence. The trustworthy AI workstream is something I would rather say you do not necessarily have every time up and running. We simply have that in order to get that going, to adopt the policy. So it was necessary for the first time, bringing everything alive. Could you please click one more time? So as said, it is all about classification. Is it a red line case? Is it a high risk case? Or is it a standard case? For red line cases, I can only simply say, simply don't do it. So at SAP, we simply check, and in case it's a red line case, we don't do it. For high risk cases, as said, we have a couple of questions. I have more detail on the next slide, but due to that we only have a few minutes time per each speaker, I won't go into all the details. You can simply, as always, you will be provided by FERMA with the slides. And for the self-assessment, you can simply have a look at slide 4, and there you see the detailed question. So in a nutshell, it is simply, are you processing personal data? And in case yes, you simply should see, is it sensitive personal data? So are you, for instance, looking at information on sexual orientation or religion or whatsoever, or biometric data? Could it negatively affect individuals? Or is there any automated decision making? So I can only recommend always keep human in the loop. Or is it within a high risk sector, for instance, healthcare? And in case you are answering 2 of these questions, so the first and at least one of the others, yes, it automatically has to go to the steering committee, where the risk is assessed deeper, and there's got to be a written approval by the steering committee that we go for it. Otherwise, it is stopped. So, and in case it is a simple, so-called simple standard case, meaning you do not process personal data, and then it is a self-assessment, and that, of course, also has to be stored automatically and auditably. Could you please click one more time? This is, as promised, the questionnaire in more detail for you to look it up. Please click one more time. Thank you very much. So these are the processes you have to have in place in your company in case you are creating AI use cases. You have to have a process for high-risk cases. You have to have a process for standard cases. Additionally, on top of your normal risk management. And as said, I can only highly recommend get the red cases out as fast as possible. So train your developers or all the potential use case developers on how to easily identify a red line use case so that you do not waste any energy or any time on red line cases. So high risk case, as said, and standard case, they all start with the use case owners, the developers jointly do the self-assessment. And in case you identified with that questionnaire I just pointed out last slide, then you have to hand it over to the preparation office so that the AI ethics steering committee can have a deeper look at your use case. You have to describe the use case, or not you, but the owner has to describe the use case, and then everything is handed over. So the DPIA, so the data privacy impact assessment is performed and so on. All this got to be done before the AI ethics steering committee so that they can do the decision on yes or no to this use case on a solid base. If there is nothing to decide upon for the AI ethics steering committee because you do not possess any personal data or whatsoever, then it is simply that you did that self-assessment, which is filed in a system in an auditable way. That's it, as said. So clear learning, self-assessment, have a framework, so a policy, and have these processes established. Kindly give me one more click, please. Yeah, and as last time there was a question, how do I determine probability? How do I determine total loss? I'd like to give you one example here. everyone who's in the call will have a risk filed with the normal risk management regarding the upcoming AI Act. So I'd like to give you, as I'm already doing this for, I got that risk, I think about 3.5 years ago in the books. So how to do that? And it is performed in analogy to GDPR, so EU GDPR. As you may remember, there we also have percentage of global turnover as a possible fine in. And you should not go for simply taking that fine as a probable total loss, because then you will easily overuse your risk-based capacity. I briefed it here to the RBC. So do not overuse your RBC. You will have quite some of these risks in your risk management system because you have to have it for all these use cases, for all these products. So simply take the best practice rule we already have established for GDPR, where you go for the 2 daily rates. And due to the fact that we are, in case you simply, like we say, no, we don't do any red line cases, so you will have possibly this 1.5% of the global turnover. You can go down to 1 daily rate, meaning global turnover by 365 and by 2 would be the rule for GDPR, and by 1 of multiplied by 1 for this 1.5 fine. And of course, you have to see how many use cases you have in the high risk area. So probability, as I think it will be more or less very likely to what you have regarding the EU GDPR, the risks you have in your book. So if you don't do proper mitigations, it is likely, in case you would not have any mitigations in place already for EU GDPR, it is more than likely. So likely is already based on the assumption that you have good governance established for the EU GDPR. But as I'm talking to European risk managers, I simply assumed that you have. So before mitigations, I would rather say likely. In case you have strong governance for EU GDPR, I would, but that really depends on what you have established. I would say around 40% probably. And after mitigations, of course, it should be unlikely. I wouldn't go below unlikely, but as said, that is just my personal experience. Anything like remote is due to the fact that you have so many parties involved. As said, it is a joint responsibility. So you have the use case owners and you have the development department and so on. And I can only say developers, you can't expect them to be experienced risk managers. And thus, I would rather say stay with unlikely, don't go that far to say it's remote. And having said that, and looking at the time, to then over to the next one. Thank you very much.
Thank you very much, Barbara. I see that your presentation also triggered some questions, but we will come back at the end of the 3 speaker presentation. I'm now turning to Salman. Salman, so to the way you will present the way a company known more for its rating and analytics might be looking at how AI and risk management intersect. So please, Salman, the floor is yours.
Thank you very much. So you're right, it's a company that's better known. Moody's is better known for its credit ratings. But maybe on the next slide, Moody's today is a far bigger organization, looking at not just obviously credit risk and credit ratings. We've now operate in a much wider space that includes data and analytics for insurance companies, for corporates, for governments, for banks as well, to help them do a number of different things that includes to actually underwrite risk, manage that risk, and then report and comply on that risk. And we've been actively investigating the space of AI in the insurance space. So I'll be touching on the impact that AI will have on insurance, and obviously what impact that will have potentially on the buyers of insurance. So Moody's obviously brings together a whole lot of data, and we apply AI to this, and then we think about how insurers could use this, but then what implications that will have for insurers and corporates. And if I take a step back, maybe on the next slide, if I take a step back and think about the pace of innovation in insurance first, right? Because we talk about AI and all the impacts it's going to have and all these things that are going to happen, we have to remember that historically, parts of the insurance sector have been innovative and other parts have not been that innovative in the use of data, in the use of technology, and there's very good reasons for that, right? Generally speaking, the more homogeneous the risks are and the larger the volume, the more likely you're going to have innovation. So if you look at retail insurance, car insurance, home insurance, that sort of stuff, those are largely homogeneous risks, and there's large volumes of them. You know, lots of individuals, lots of houses, and there, when you go to a retail insurer, you will see a lot of innovation, a lot of use of data, and a lot of use of pricing models to select the risk. In fact, actual underwriting doesn't even happen now in retail insurance. It's all just pricing using a model and having some risk appetites. And then you go to the other end of the spectrum and you look at corporate specialty insurance, where you're actually underwriting the risks. So that's when you have specialized risks. Generally speaking, they tend to come to the Lloyd's market. I can see Marco on the call here as well. But a lot of the specialized specialty insurance risks do come into the Lloyd's market where they are actively underwritten. And there is lower use of technology. There's lower use of data as compared to retail insurance. Now, and that's because the risks are not homogeneous. And it's called specialty insurance because each risk is nuanced. Each risk has special information you need, information that you need. So you need to actively underwrite them, and underwriters and brokers will all play a role in writing that business and modeling that business. And in the middle, you'll have what's called the SME universe, where there is a large level of homogenization, but it's not fully homogenized. There is a reasonable level of processing, and therefore there's a lot of automation. And that has several implications. Now, because and I'm looking at the FERMA audience now, a lot of the risks that you probably have are probably not homogeneous risks, right? They're risks that will require special cover or specialized knowledge of industry or sector or risk. And because of that, the data standardization isn't as high as it is on retail insurance, as an example, right? So with car insurance or home insurance, that data is fairly standardized, it's very robust. So you can very quickly build models on top of that, and you can very quickly use generative AI. On the, like I said, other end of the spectrum, the risks are not homogenized, and therefore the data is not homogenized. I'm sure you guys are used to filling in very long submissions for your insurance cover, all asking all sorts of questions. And sometimes you feel like these questions are too much, and then you get another request, and it's a complete different set of questions. It's because the risks are specialized and they don't have a lot of data standardization. As a result, you don't have a lot of application or as much application for Gen AI and models as you do for retail insurance. But this gives you an idea of what to think about, what to expect from your insurer in their use of Gen AI. Now, what's important to say is that does not mean that corporate specialty insurers will not use Gen AI. They will. But it's how you think about where they play versus the retail insurers and how they've historically innovated. However, like I said, generative AI still represents a major area for insurers to improve their value proposition, to improve their efficiencies, and we'll talk about that in just a bit. But more importantly, there will be implications for buyers, and I'll talk about that as well. So on the next slide, I'll talk very quickly about some of the use cases we're seeing now emerging in insurance and the use of generative AI. And this is primarily focusing on corporate commercial insurers. So this does not include the retail guys, but inevitably there will be some SME business in here, which can be auto underwritten. And we've kind of broken this down into a number of different ways of thinking about how you can use it. At the very bottom is the use of generative AI in what we call just descriptive tell me, like tell me what's going on with this, just interrogate a data set or interrogate something and give me a summarization of it, right? So in that situation, this is the use of generative AI in customer service chatbots. We're going to see more and more in that, especially, like I said, in the SME space or in the small cap mid-market space. But we will also start seeing it more and more in risk evaluation. A broker submission comes in, or you submit something to the broker that goes to the insurer. They might use generative AI to quickly summarize that submission, right? So it's going to speed up that submission process. Then the next level up in terms of use of Gen AI is to automate certain processes in the underwriting process or in other processes to improve speed. These predominantly relate to reporting and analytics. So can you run a NatCat model for me? Can you run my flood scenario? Can you run my exposure to North American hurricane very quickly, or cyber very, very quickly? Kind of instruct the model to run for you using certain parameters. And the same thing in what we call risk management. And when I say risk management, I mean insurance risk management. So the interrogation of data and summarizing that. Going one level above, and this is where it gets really, really interesting, is how can we use Gen AI to predict when or if a claim will happen or when a claim may happen, right? So again, going back into the underwriting process, a submission has come in, and you can use Gen AI to summarize the submission, of course, but then look at additional analytics that you may have had to predict what the potential loss behavior could be. That could look at historical loss ratios, that could look at claims experiences from other companies, but instead of an underwriter doing that, using Gen AI to do that as quickly as you can. And then to do that in claims as well. I think we've already seen examples. Again, I'm talking about the retail space for a little bit, but you can, when you have an accident for your car, you can submit a picture of the accident, and a bot will read that and give you a number. I think going forward, if you have property damage, if you have damage to machinery, these sort of things, you could submit pictures, you can submit videos, and a Gen AI bot can read that and very quickly give you an initial assessment. There will always be a human in the loop, especially for claims, and especially for specialty insurance. But where there is a quick decision that can be taken, we can use Gen AI to quickly figure that part out. The last level, and I think this is going to take a very long time. In fact, or it may not take a long time, as technology is changing quite fast, is advising. So up until now, there was a lot of human interaction. At this advise me stage, an underwriter kind of slowly moves out of the loop, and the Gen AI basically says you should either underwrite this or you should not underwrite this, and it speeds up the entire process. And the underwriter basically just says it looks about okay or doesn't look okay. And we're starting to see some of this now in the auto underwritten stage. At Lloyd's, there's a lot of smart follow, it's called. I'm not going to get too much into that. It's algorithmic underwriting. But fundamentally, you're using machine learning to figure out what the best risks are and what to quickly underwrite and what needs a human. So I think these are the levels of AI that we're going to see over time. But like I said, it's going to take a bit of time to see which one of these will percolate all the way to specialty insurance. I think all of these will be used in retail insurance. I think some of these will be used in SME and mid-market insurance. I think some of these will eventually make their way into specialty insurance. It's just a matter of how quickly the data can be standardized, how quickly people can get comfortable with the data, and how quickly data moves across the value chain. That's the other part that's unique to insurance. You have your insured client, your members, you'd have a broker, and then you'd have a carrier. And that data transmission takes a bit of time, and it's not standardized. So the quicker that becomes standardized, the quicker AI can be enabled in these use cases. So then just moving on to the next screen, I guess the questions that you guys would have is, what implications does this have for the buyers of insurance and the large corporates? And a lot of this is speculation at the moment. Like I said, there is still a lot to happen. So this is me speculating, having worked a lot in insurance and having seen a lot of what's happened, but this is the direction I think things will go in. And some things I think will definitely happen. Some things are up in the air. One thing, and it's a hope, and I think it should happen, is submissions should start getting more and more standardized, because companies should become, carriers, insurers, and brokers should become clear on what data they actually need and what data is superfluous. So that should help standardize some of these requests, and that should help simplify some of these requests over time. Again, it will take a bit of time. But then hopefully as a result of that, there should be faster responses to your needs, right? Because generative AI should be, one of the problems that happens in insurance right now is, and we saw a study on this, about 35% of underwriting time is spent on just gathering data, assembling data together. That's more than 1/3 of their time is spent just getting data from here, from a broker submission, from a third party, or like us, for example, and putting it all together. And hopefully with generative AI, you can assemble all your data very quickly and get actual risk insights. So that's 1/3 of processing time that can be cut out, which can be used for decision-making. So hopefully in the future, you should get a faster response to your needs. These things I think are inevitable and they will happen over time. But what are some of the implications beyond that? Does that mean you will have less differentiation of your risk versus another risk? Will we move towards that retail space? You remember in the retail space, we said all risks were homogeneous. Give me 5 data points and I'll give you a price. And whether you're a good driver or a bad driver or an average driver, you just get lumped into a pool of risks and you get priced like that. And if you're a good driver, you pay more. If you're a bad driver, you probably get away with paying less than you should. And I think the use of data is great because it's efficient, but it does create a pooling of behavior, saying these are risks all look like the same. Can we just price them the same? Can we just select them the same? So does that mean that all the additional risk mitigation work that you're doing goes out the window? I hope not. I think they will still be taken into account, but it does mean in the future, there might be, and this is speculation, there might be less differentiation. What impact will that have on pricing, right? So in theory, you would expect there should be lower pricing because I just said 35% of time is being used by data gathering. If we can get rid of that processing time, we should pass those savings on to corporates, right? You would say, oh, I should get 30% off. Probably not going to happen, right? Because they probably have to pay for their investments in Gen AI, number one. But the other thing to remember is pricing for insurance isn't a cost-plus approach ever. Pricing for insurance is driven by demand and supply and what's called a hard market and soft market approach. So inevitably, it's not a cost-plus approach just because you incurred less cost. You're going to pay for that somewhere else. So I don't know what the impact on pricing will be because if I look at the retail space, has the use of data reduced our costs in home insurance or car insurance? The answer is no, because the nature of risk has changed. That's the other variable in this. And I think the nature of risk will also change again. And I think that's the last part. Generative AI, whilst offering a lot of efficiencies, will change the nature of risks that have to be covered. So new cover will be needed that is not being purchased today. Just like when the internet came in and we all found efficiencies from the internet, you need a cyber cover. And cyber cover came into business interruption because it's contingent business interruption, ransomware, malware, all the additional coverage that you need now. Remember, these covers didn't exist before the internet. And I think as Gen AI comes in, new liability exposures will be revealed and they will need new cover. Some of that will be to do with business interruption. Some of that will be to do with indemnity and reputational damage if your chatbot goes crazy or something. Some of that will need to be about D&O as well, and regulatory intervention. Legal, if your chatbot is giving inappropriate advice or incorrect advice that you're on the hook for. So new risks will emerge, and they will need new cover. And this is an area that insurers love this. When new risks get exposed, they will find a way, hopefully, of covering these new risks so that you can do your business with confidence. That's the whole role of insurers. And I can see Marco's nodding, so it feels like I'm saying all the right things here. So I'll stop there. I appreciate I'm just up on time, so I'll stop there.
Thank you very much, Salman. Very interesting. So thank you for your insight here. Now we will hear another perspective from the London market about AI and risk management from Marco. And by the way, FERMA is very grateful to have worked closely with Lloyds on our initiative into AI. So Marco, please, the floor is yours.
Thank you. Thank you. Yeah, I feel Salman has done a lot of my introduction. So maybe I will adapt my intervention and go a little bit, slightly more high level, and give you the perspective of the Corporation of London. So from where I am, I have a privileged point of view because I see what's happening in the market. Lloyds is this conglomerate of 100 more or less syndicates, each underwriting in their own way, and we at the corporation oversee the operation across these 100 entities. So I have the privilege to see the more advanced and esoteric applications, and also the first steps, the tentative steps to some extent. So in my first slide, I put a selection of what is going on, and maybe a little bit of a speculation, if you want. But maybe talking about cyber specifically, that's a very good example of a line of business where AI maybe in its machine learning meaning. So, more on the predictive side, if you want. But AI has already been implemented and giving useful insights for some time. Notwithstanding that you still have to fill forms with hundreds of questions. And we talk about how that might go away. Salman has already mentioned. But in cyber, what happens is underwriters have now found a way to marry their own experience, so their claims data and their all of day-to-day operation and relationship with their clients, with the wealth of data that they can harness about cybersecurity and cyber intelligence. And by marrying these two data sets, they are able to tailor a service to their clients. And by doing so, they are able to identify those threats that pose an existential risk. Those threats that can become, so big to pose a problem for their portfolio. And by providing a service to their clients attached to this analysis, they also ensure that these big events also, mitigate their effects on their client base. That's a good example of something that is already happening in the market, and we can see potential for that to happen in other lines of business. And one aspect that I care about a lot is climate, for instance. And it wouldn't be nice a future in which we underwrite property in a very similar way, whereby instead of moving away from those areas where climate risk might be heightened, providing a service to our clients to increase resilience. Some of that is already in its infancy, so it's not quite in the market yet, but I can see the seeds for it. That's why I mentioned it. Now, AI is going to impact everywhere. And you've heard the previous two speakers saying that, and it's not, you don't need to be a PhD or having a particularly deep knowledge of the subject to see that this is happening. Our role as professionals is to remain human and to let the machine do what the machines are good at and bring the human, enable the humans to do what the humans do best. So this means that the transaction of the insurance should move into a world where it's more streamlined, it's more efficient, it's more transparent. And maybe that comes with a little bit more of data transaction, right? So whereby instead of filling millions of forms, maybe you give access to a data set that the insurer can access via their robots, for instance. But then you will always need the humans to do the humans. No client will ever be happy to speak to a machine when they talk to their insurer. Let's be honest about that. So that human interaction is here to stay, is not going anywhere. But then the other thing that I think about when I think about the various lines of business is how the risk evolves. And it evolves in three ways. You have risk that are evolving because our clients are implementing AI in their operations. This means that they are doing more of what they usually do, and they're doing it in a slightly different way, which evolves the risk. And we need to be ready for that, and we need to be aware of that. There is going to be the need for new products, and I have there a hint about AI assurance just in the middle of the slide to hint that there will be the need for products specific for the robots and what they are doing. But then the third aspect, which we all should be aware, is those risks that we can think of at the moment because they are just hidden in the way in which we implement these robots, and we don't really see how they will evolve because we haven't implemented enough robots yet. And that those risks will happen and will appear in all classes of business. And that is what I call silent AI. It's there, it's going to happen, but we don't quite know where it's going to happen and how. And we need to raise awareness of this, both within the insurance industry, but also with our clients. Because if the insurance industry gets caught by surprise and unprepared, ultimately the people who suffer are our clients, right? If an insurance company becomes insolvent, the claim doesn't get paid. In the next slide, I bring this a little bit forward, and I talk to the role of the insurance industry and what do we do. So again, I'm preaching to the converted. I know, audience of risk managers, but you all agree with me, I think, that insurance is the industry of resilience. And we fulfill our role of a partner that helps businesses fulfill their, go about their business, going about providing the services that they provide. And we are there to provide a helping hand when things don't go quite as planned. And also, maybe we also are there to promote, best practices across an industry, for instance, with policies that help understanding where the gaps in your risk management might be. Now that function, we need to fulfill that function also for AI risks. It is important that we innovate, and and again, we've heard both previous speakers saying that. So I'm afraid we all sound a little bit like a broken record in this, but it is important that we innovate, and it is important that we educate. So webinars like this, very important. New products, very important. Continue the conversations with our clients to understand where their needs really are. Because I totally agree, if it's a red flag, you don't want to do it. But if it's high risk, you want to do it. And because it's high risk, you may well want your insurer to be there when that risk materializes. So we need to be there as an industry, and Lloyd's is well placed to be there as a partner because we have a history of innovation. And in the next slide, I provide you a snippet of the things we do at Lloyd's across the market to engage with this innovation. At Lloyd's, we have the Lloyd's Lab, where every 6 months, we bring a cohort of around 10 to 12 tech companies. I have been fortunate enough to have been going through this process in my previous role when I was building cyber models. And now I see the process on the other side by welcoming in these cohorts every 6 months. And here I put a few examples of companies that have come to the lab very recently. In fact, 2 of them are currently in the market in this cohort, providing solutions with or for AI. Sixfold, the logo in there, is a company that provides operational efficiency. They're using AI to digest data. So the specialty market, right? So we are looking at Lloyd's. Lloyd's is a specialty market. Again, thank you, Salman, for helping me explaining this in the first place. And we receive complex risk. We underwrite complex risk. That is our reputation. And Sixfold will help digesting this unstructured data and making it available to an underwriter, the human in the middle. The person in the end will have to make a decision, but that 30% of the time spent in putting data from one side to the next, maybe Sixfold will solve it. Maybe not, we don't know. It's a tech company, it's a 10-week program, we will see. Vio are a company that are looking at climate. They are predicting weather patterns, climate condition weather patterns, and they are trying to establish how the patterns of risk change on the ground. And this means that they are one of those companies that should enable us to move in this world that I have described, where we are able to provide a service to our property policyholders to suggest ways in which they can mitigate their risk to climate. And finally, Armilla and Cover Your AI are 2 companies that are providing insurance for the robots. And that is, as I was saying, the case when you want to provide that high-risk application, you want to implement the robot in that situation. Once you do it, they will be there to cover that use case. With that, I think I am at time. So thank you very much.
Thank you very much, Marco, and thank you to all of you. I will now take some of the questions which have been posted on the chat, but if you have additional ones, do not hesitate to post them now. So, well, as you know, also risk managers are also looking at AI and how AI could help them in their day-to-day job. So there is a question about if you have any thoughts on the application of generative AI tools in the process of assessing and managing emerging and future risk for risk managers, basically. So Salman, you covered a little bit of that. Do you want to start answering this question? And then Marco and Barbara, please feel free also to chip in afterwards.
So I'll keep my comment short. I think Barbara might have a few interesting points on this, and of course, Marco. So the short answer is yes, of course. This technology can be used to predict and look at long-term risks. But I think horizon scanning at the moment and looking at emerging risks still needs a lot of human touch, right? I don't think yet the chatbots or the chat GPTs have evolved to a level where it can do that. One thing it's probably very good at is looking at data and not predicting, but trying to forecast a few scenarios. And then you can test out those scenarios for different things. So I don't think at a quick level at where the technology is today, it's probably not at that level, but I don't see a future where it couldn't be at that level. But I still think that horizon scanning and looking at emerging risks, that will still require quite a lot of human input. But that's just my view. I'll hand over to the other panelists on this.
Barbara, would you like to, or Marco? Cool.
I was just saying, I'll chime in with a couple of comments. Maybe first of all, I agree. We can't really use this technology to, as a crystal ball yet, right? So we still look, we still look at what the world around us look like, and we still apply this human element to it to do the horizon scanning. But where the technology actually is very powerful is to provide, some insights on the counterfactuals. You look at what is almost happened, and you can use this technology to actually give you ideas about what might happen. What might have happened instead, because it's a very good technology to do exactly that. You can think about these generative AI bots in all their description as magnifying autocomplete. So you give them a set of initial conditions, and then you tell them what happens next. You ask them what happens next. And so doing the counterfactual is the perfect application, in my view, at the moment for these tools.
Barbara, would you like to add anything?
Well, I would rather say we have two totally different views in this workshop right now. So you have the insurance view, and I have, of course, the risk manager view on new use cases. So I shouldn't say anything about insurance risk, not my area of expertise. Simply, when we talk about probabilities, when we look into the LLMs and what are they trained on, they are trained on past data. It's all probability based. So there is a high risk, and that was also one question I saw in the Q&As. There is a high risk of low quality data. So I can only clearly say, if you do zero prompting, so anything without prompt engineering, you will get hallucinations and you can't use it, especially not for emerging risks, due to the fact that it was trained on the past. And we are not an insurance, so quite obviously we won't train any LLM solely for risk management purposes. It's not worth it for a normal company. And I can only say, don't use a normal LLM without special architecture for any risk management purposes. I put some information already in the Q&A, and I would rather say we should have a dedicated session on that one.
Thank you, Barbara. And linked to the comment that you've made, there was indeed, and there is a question about, the structuring of the data. So it's true that a lot of companies have a lot of data which are not structured. So the question was, can AI be instrumental to structure data for leveraging data and therefore help to make data available for individually underwritten risks? Anyone who would like to add on that?
Well, there is a lot to unpack in this question. Actually, there are at least three different aspects. So on a very basic level, I have alluded to it. These models are very good at summarizing data. You provide a very complex submission with hundreds of pages, and they are very good at summarize it and get you to the actual essence of what is being submitted. The training is the clue is the more the training, the better, right? So the training is the most important part, but if you do the training right, you will get there. And, for instance, in specialty property underwriting, where you receive these engineering reports, they are structured or in very similar way because the engineering profession is trained in a very specific way. So this is the typical example where these hundreds of pages can be digested a lot more quickly. It doesn't remove the need for the production of those 100 pages, let's be clear. But what this enables an underwriter to go through a couple of these reports a day instead of spending a couple of days in each of these reports. and ultimately will make more insurance available for our clients. So that's one aspect. It's important. But then the question was also going in the direction of, can we use the AI to structure the data? So can we go into this level where we create synthetic data? And this is a little bit, it's an application that exists. People, we see this next generation of models, GPT-5 and all that, and there is a lot of speculation about what's coming. And now, we don't really want to go in that direction, because we only want really to talk about stuff that we can do today, and not what we might be able to do in 10 years or 3 years or in 6 months, if you believe the hype. But there is potential for that to be an application in the future. We are not there yet at the moment. Then the third element, which I think it's important to also mention, the robot will not remove the humans. We just need to learn how to be humans in some sense. So I don't see a world where the transaction of insurance, or actually every transaction, will be only happening among robots. So you will have operations in your company that will generate data in a way more efficient and will give you insights as a risk manager in a much more efficient way. And the fact that you have that information now enables you to have that conversation with your underwriter. And that conversation, which is happening between humans, will be enabled by the exchange of data, which will be more efficient because the exchange of data will happen between robots. That's my view.
Thank you, Marco. And there is also a question about the liability. You also mentioned the liability. So who is taking care of the liability for the quality of information generated by generative AI? So Barbara, in the EU AI Act, is there something regarding who is liable?
Well, if you are using Gen AI and really think that you get high quality data without feeling responsible for let's say providing high quality input, so prompt, then of course no one is liable. Then it's simply misuse of LLM. So we can't say a simple yes or no to that question, and that person or whoever is responsible. The quality of what you get is very much reliant on what you put in. So as said, you have to engineer your prompt. And we already had that regarding emergent risks and regarding structuring data. I can only say for the normal company, you have to have RAG, so retrieval augmented generation, meaning you have to have a special architecture with a local database. And we, of course, use the HANA reference engine, so that you reference your personal, your private, your secretly stored database. And then it is always referencing your personal documents, your personal trustworthy and compliant stored risk management data. And then, of course, you can expect quality. Otherwise, you will simply get hallucinations. So to come back to the question, then I would rather say the quality is up to the one asking.
Thank you very much. I'm looking at the time, and unfortunately, I think we could go again for 30 minutes, 1 hour, but unfortunately, we have to end this webinar. So thank you very much to our speakers, Barbara, Marco, Salman. And thank you to all of you for taking part in this webinar. Just some small ads for the upcoming ones. So the third webinar of this AI series will be on Thursday, the 13th of June. So really watch this space for further announcements. But before that, next month, we will run a webinar on cyber reporting stack together with WTW, and it will be on Thursday, the 16th of May. So if you want, you will receive the replay of this webcast. You will also receive the slides. Those of you who are REMAP certified, you can log 2 CPD points for attending this webinar. So again, thank you to all of you and see you next time.